How to find genuine supply and demand zone for a profitable entry. The forex market has turnover of $7 trillion or more, and to move a popular pair like Euro USD, it is going to take millions if not billions in buy or sell orders. And it is usually big banks or institutions like retirement funds have billions to place those big orders. So once these big players come into the market, their big orders usually create large impulse move of long body, and this move is our key to catch profitable trades. So the basic price movement of an asset is due to supply and demand forces. If you learn to spot these supply and demand zones, you will be able to catch smart money and trade with big players. This is one of the methods to find out if the big players are in the market. So when you see a sharp movement in the price and there are 3 to 4 candles in the same direction, it is an indication of institution entry. However, it is important to understand how supply and demand zones are formed. Let's take a real-world example rather than boring supply and demand zones. You must have seen oil price going up and down in the international market. So when OPEC countries cut down oil production, the oil price go up in the market because of reduced supply, but the demand remains same. However, when the demand of oil is decreased, it reduces its price and can even go below zero. And there are other situations like war and global pandemic. In such situations, the investors move their asset into gold and other safe havens. Hence, the high demand of precious metal increases, which leads us to balanced and imbalanced market. In a balanced market, you get equal buyers and equal sellers, whereas in an imbalanced market, you get more buyers than sellers or more sellers than buyers. To simply understand, a balanced market is a range-bound market or sideways market, whereas an imbalanced market is a trending market. So in an uptrend market, the buyers supersede the sellers until the sellers take over. A real-world example is auction. So if there are more buyers in an auction than sellers, the imbalanced buyers will drive the price higher till the buyer is exhausted, and vice versa for more sellers than the buyers in a downward market. Coming back to charts, so when the price reaches to the supply zone, the orders get filled and the price of asset go down. As you can see, it happened several times around this zone and eventually price went down, which shows high interest from sellers. On the flip side, near these demand zones, the buyers exceed sellers, hence the price end up going up. Now to the strategy. So to trade supply and demand zone, you have to focus and spot one thing only, that is aggressive buying and aggressive selling. It is because the big players are in the market and you have to learn to spot this zone and ride the wave with big players. Let's find out these zones on a chart. The base candle. For each supply and demand zone, we need to find a base candle. A base candle is located before the sharp movement of the price. Long body candles. After the base candle, when long bodies are formed, they indicate that the big players are in the market. In this example, the price dropped sharply after a small upside candle. So we are going to mark this zone as an area of interest and wait for the price to come back to this marked area and enter a short position. Also, make sure for the price action to occur before you enter the trade. Always remember, never enter a trade based on a single confluence. Moving on. Here is a downward trend example. The principle is same. Mark the zone of last opposite candle before the sharp decline. The mid-movement zone. This type of price happens when the price is moving in one direction and during price movement there is a small pause which creates an opposite candle. In such a situation, we mark the mid-movement zone. As you can see, we have two mid-movement zones. However, the extreme zone is going to be the most strongest. When you marking a mid zone, always consider the extreme zone as an entry point. You can see the price reacted against the latest mid zone, which most of the time turn out to be a weaker zone. Therefore, the extreme mid zone should be the area of interest when you are trading with mid zones. Here is the second example of mid zone. In this case, the mid zone was only available once, as the initial extreme zone had red candles with long wicks, which is not the definition of supply or demand zone entry. Now, how to find the supply and demand zones on a chart. So from the current price on the chart, look towards the left side of the chart and spot a sharp movement of the price which should contain 3 or more long body candles. Once you have spotted, mark the opposite candle before the sharp movement. On the trading view, pick up the range tool and mark the base candle before the impulse move. So once the price returns back to the area of interest, enter a trade, long position, with the stop loss below the recent swing low and target the recent swing high or the body of the swing high. Now if you move left, you will see some long price movement. However, the initial candles were not long body candles, hence we will ignore it. These red candles have long body, so we would have entered a short position targeting the previous reversal candle. This is another sharp move, and interesting to notice that for this demand zone, the price eventually returned back to it. So if I scroll right, you will see it is hitting the demand zone to move up,